Hello everyone, and let me be one of the first to wish you a Happy New Year from all of us over here at Richmond Brothers. Thanks for tuning in. This is the December edition of Matt's Minutes, but I am filming it in January. We wanted to make sure and have some year-end data to be able to comment, give you some of our thoughts and some of our perspective as we continue to work with each of you individually on your portfolios, on your allocation, and on thoughts as we head into 2019. So with that, let's jump right in. I'm going to title this one Greed or Fear. Why greed or fear? Because those are really the two things that either drive the markets one way or the other. And you'll see some pretty famous quotes by Warren Buffett on greed or fear. And it seems of late, especially in the last 3 months or so, fear, of course, is what's driving the markets, not greed. The markets don't seem to be growing, and in fact, the fourth quarter of 2018, so from September 30th or October 1st to the end of the year, was in fact one of the toughest on record. If you look at the broad market indices, the Dow Jones Industrial, the S&P 500, the NASDAQ, those are all familiar broad-based indexes that you probably see on news channels, here on news networks. Just in the last couple of months, the least negative index was negative 12.5%, and the most negative of those three was minus 17.4%. And so where do you turn if all the markets are off? Well, we've gotten a few questions. Can't we just own stable companies? You know, great products, great management teams. And so we also pulled some charts in addition to the market chart you just saw. You may have heard of the FANG stocks. That's Facebook, Apple, Alphabet, which is Google, Netflix, Amazon, those sorts of names. If you look at that same period, just to put some broader perspective to this, the least negative of those mega stocks was negative 13.4%. The most negative was 30.6%. This is all within a 3-month window. Think about this. Is Amazon going out of business during a time when holiday shopping and spending, especially online transactions, were at an all-time high or near a record? Probably not. So there seems to be a disconnect between the indicators in the economy versus what's happening in the market, and that's why I titled this on the fear side. Fear tends to be driving the market, not logic, not data right now. And so in the fourth quarter and most of 2018, if you had any stock whatsoever in your portfolio, or equities is the name of that category, there really was nowhere to turn. And if you own stock, investments were down, portfolios were down. And so by and large, it was a really, really tough quarter. Now, do we think the sky is falling? Do we think we're tipping over into recession right now? When you look at all the economic indicators, and it's important to look at economic indicators to give you a sense of where you think the future is headed, we do not believe we're tipping over into recession right now. Is it possible that we're going through a little bit of a slowdown? Yes, that's certainly possible, but that does not mean that the market will just keep getting more and more negative and stocks will keep getting more and more negative. There's some psychology at play here, and you see a little bit of a slowdown in economic growth in China. So you have questions of how much did trade wars and tariff wars have on the impact of Chinese economy in the fourth quarter. And so you're certainly starting to see some data come out on that. Our GDP in the U.S., gross domestic product, is still positive and still relatively strong. There has not been enough tariffs instituted to basically push the economy and the growth down far enough where we'd start to get concerned. That is certainly something as we move into 2019 we'd like to be aware of. And so some thoughts that I guess I have for you and we have for you. I've gotten some calls and some emails and some questions. Should I just put all my money under the mattress? Should I bury it in the backyard? Of course, that is an option that you're certainly welcome to do. Would we suggest that? Probably not. Psychologically, what happens is when the market goes through the roller coaster, you know, psychologically we go on a downswing and we want to control. So we start pulling money out right here and we say, I want to sit in cash. I'm going to wait until I feel more comfortable. And so you wait and the market swings and it comes back up. And we wait until we feel more comfortable, and then we missed all of that recovery. And so that's the toughest thing, because we feel like we want to grab control right now, and get more conservative, but that's probably not the right thing in the end. We do think there'll be some opportunities to take advantage of that strength in 2019, and just take a note of some of the charts that I put up for this discussion. We are here for you as much as we want everything to just be smooth sailing. Unfortunately, in this world, there's a lot of volatility, and it's really hard. I can't control the environment. You can't control the environment. We are here to help you navigate through the environment, both good and bad. We want to continue to work with each and every one of you on your meetings, phone calls, discussions, using Riskalyze and continuing to review your individual risk tolerance. So as we move through 2019, we can continue to use that to see how conservative, moderate, or aggressive we continue to make investment allocations based on that. As always, if you have questions, if you have thoughts, don't ever hesitate to reach out. Questions at richmondbrothers.com. We still don't think recession is likely until we move into the first half or second half of 2020. So ideally, again, we want to use 2019 when we get a little bit of a swing back. As we would predict, we'd like to take advantage of those swings back and start to get a little more conservative for each and every one of you as we move closer to 2020. Thank you so much for tuning in. Thank you so much for your continued confidence and trust, and we are all here for you, and we appreciate having the opportunity to serve you.